All right, the future is mixed in the pre-market, but as we told you, the S&P and the NASDAQ both coming off record closes. And joining us right now to talk about the markets is Elyse Ausenbaugh. She is the head of investment strategy at JPMorgan Wealth Management. And Elyse, there have been all these questions with the rebound we've seen in the markets since April. People were saying, hey, there are pretty high expectations heading into earnings that people want to see this. You've got a really interesting call on this. You think there doesn't have to be an all-clear call on everything else that's happening with the geopolitical headlines, with everything else. You just think we need to see some steady progress continuing when it comes to what companies are earning.
I think that's right. And earnings season is proving that so far. There are a lot of compelling micro stories, be it related to artificial intelligence or security spending in Europe, and even these potential tailwinds coming from the One Big Beautiful Bill that I think investors have shifted their focus to and really started to embrace. And that's what's continuing to drive markets higher.
What are the tailwinds from the One Big Beautiful Bill? Because we have been hearing from companies like AT&T and Verizon, who are talking about the benefits they'll be seeing and what they plan on doing with that cash. Yesterday, AT&T said it's going to see $6.5 to $8 billion in benefits from the One Big Beautiful Bill, and it plans to put that money into infrastructure spending over the next couple of years, along with beefing up its pension plan.
Yeah, I think it's those provisions related to things like R&D spending and depreciation.
But you said tailwinds, not headwinds, right?
Oh, correct. Yeah.
Okay. Sorry, I misheard. I heard headwinds.
Look, and the company you mentioned isn't the only specific example. There have been others in the consumer sector, for example, that are talking about this as an offset to what they had originally feared as it relates to that tariff headwind. And I think that's the kind of thing that investors are willing to kind of consider as they look through the potential for economic data to weaken in the second half of this year.
Okay, what about the AI race? What about the CapEx spending, like what we heard from Alphabet?
I think it's really encouraging and it's validating our thesis. What's really important is that you're finally starting to get this positive feedback loop where corporate adoption of artificial intelligence is growing. It's twice as high as it was last year, and it's rising at a rate around 4.5 times that it was in 2024. Furthermore, there was this recent survey put out by the Fed, or excuse me, not a survey, but a study put out by the Fed that showed that those sectors that have higher adoption rates of artificial intelligence have enjoyed higher productivity growth since 2019.
Okay, that's going to be the big issue, measuring that productivity growth, trying to figure out what it means. Because if you just look at the CapEx spending, it is the companies like the NVIDIAs, the Broadcoms that are benefiting from this. It hasn't helped everybody else. But it's much harder to try and figure out the productivity gains on these and maybe the potential savings rates for companies that are adopting these things.
Definitely. And we're looking at a lot of different measures to kind of gauge that. I think one of them that's been really helpful is even considering how headcount has maybe changed or stayed flat amongst specific companies.
Changed meaning gone down. You don't have to hire as many people when you have AI helping you out.
Exactly. And what's happened to their revenues and their bottom line profits along the way. There are multiple anecdotes where we see encouraging signs that that productivity is potentially feeding through, that you're getting positive operating leverage from all of this investment in AI.
Is there a point, I mean, if it's been so helpful to individual companies to say we can produce even more and we don't have to hire anyone else, in fact, we might be able to even reduce headcount, is there a point where it comes back and really bites us in the rear because it affects the jobs picture at that point? I mean, what's happening so far with the jobs picture? What's happening with the broader economic views as a result?
Look, I think it's a really apt question because while I'm encountering a lot of investors who are willing to embrace kind of this bullishness around AI, that is the multi-year fear. That said, I think the dynamics that you've seen early stages in terms of AI disruption to the job market are suggesting that while maybe some hiring in certain subsegments of tech, for example, have been slowing down, there are new jobs being created that are really enabled by the technology. And I think there could be some friction along the way, but we've been through this sort of creative destruction before, and the economy has evolved. And
it's just happening at a faster pace, I would say, with AI than it ever has before. You would say to buy at these levels, even though the S&P is hitting a new high, the NASDAQ's hitting a new high, you would say buy, and you think it's going to go how high?
Look, I think we're cautiously optimistic, and while the index is currently trading around our base case range that we're expecting by mid-year 2026, now is a time where we're starting to entertain that bull case, where we could potentially see the S&P 500 rising to 7,000. I would characterize our view as cautiously optimistic, and we're encouraging investors to step into markets in a prudent way. There's not just one trade. We really want to focus on identifying potential vulnerabilities in portfolios because a variety of risks are still out there. But across asset classes, across regions, I absolutely think there's still opportunity.